Hello and welcome to Unacademy IAS, a one-stop destination for all the English medium civil services aspirants. 1st of February, that's tomorrow, the Government of India will be presenting the budget applicable for the next financial year. Multiple important announcements are expected. Out of all the things that you need to focus, there is one very important area which is indispensable if you are a civil services aspirant. That is the area of deficits. What is the importance of the numbers that are published in the budget documents? If you want to understand that, first you should have conceptual clarity regarding the deficits. And that's what we will be checking today in this particular video. There will be multiple MCQs, conceptual ones on different deficits. I'm expecting you to pause the video at the start of every question, solve the question, then play the video, listen to the discussion, and then compare whether the answer that you have decided is matching with the correct answer. Let's begin with the first one. Before that, a very important announcement. A lot of you are preparing for the Civil Services Exams 2027. If you want to clear the exam in the first attempt, you need to have a structured approach. There is a need to cover the static portion comprehensively, correct approach towards the current affairs, correct reading material, sufficient number of prelims as well as mains test series. All of this is available once you enroll into our courses, which is available right now at the lowest ever price, 17,999. Those interested, check out the details by clicking on the link provided in the description below. And whatever is a mention, whatever price is mentioned in the website, do not worry, use the code IAS English and you will receive the discount. Do not miss out. Check out the details if you're interested in enrolling into our courses. Now let me start with the question number 1. This is mainly on fiscal deficit. Consider the following statements. Again, I'm reiterating this. Pause the video now. Solve the question within 1 minute, then play the video. Then compare whether your answer is correct or not. Statement number 1. Fiscal deficit can be bridged by borrowings done from domestic market only. Underline the term domestic market only. What is the basic idea of a fiscal deficit? You have total expenditure. You have total expenditure, that is the number that you've derived from the revenue side of the budget, the revenue expenditure as well as capital expenditure. From the total expenditure, you will subtract basically the revenue receipts and the non-debt creating capital receipts. This essentially will give you a difference of a number. What does the difference represent? It represents how much additional money you are spending compared to your income. How much you are earning, how much you are spending. Your expenditure is greater. That's the reason we are calling this as fiscal deficit. Now, when you have fiscal deficit, how do you bridge it? You are allowed to borrow. You can borrow from the domestic market. You can borrow from external market. So come back to the question here. First question, fiscal deficit can be bridged by borrowings done from the domestic market only. Incorrect. Indian government has no borrowings from external market. No borrowings from external market. Important term. The government of India has certain amount of debt. Now, when you look at this particular debt, it is divided into internal debt as well as external debt. Of course, yes, the internal debt forms the majority part, more than 95% or around 95%. But does it mean that government of India does not have any kind of a borrowing from external market? No, there is a borrowing done from external market, but it is very, very less, hardly around 4 to 5%. Right? So second statement is also incorrect. The disinvestment receipts will increase the fiscal deficit. The disinvestment receipts, mind you, essentially are source of income for the government. The government sells certain assets and earns this particular money. Now, here is a question for all of you. I want you to tell the correct answer to this question in the chat section or comment section of the video. The disinvestment receipts are part of revenue receipts or capital receipts. What is the correct answer? Let me know in the comment section of the video. So disinvestment receipts will increase the fiscal deficit? No. Fiscal deficit is there. If you sell the assets, you will collect money. It will reduce the fiscal deficit. It will help in reduction of the fiscal deficit. Third one, incorrect. So all the three statements are incorrect. Right option for the question is option D. What was your answer? Was it the same? Check it out. Next, second question. And before I start, tomorrow, like I said, the government of India is going to announce the budget. The Ministry of Finance or Finance Minister will lay down the documents on the floor of the parliament. You need to understand a detailed analysis, or you need to have a detailed analysis of the budget announcements. And that we are going to do live on the same YouTube channel, that is Unacademy IAS English YouTube channel at 6 p.m. Do not miss out. It will be live. It will be a detailed analysis of the budget announcements done tomorrow. Now, let's start. Consider the following statements. The government having revenue deficit represents a dis-savings of the government. It is true, by the way. Dis-saving means what? You are spending more compared to your earning, right? And basically here the argument is, if you have a revenue deficit, it means under the revenue head, under the budget, there's a revenue head. There is a revenue expenditure, revenue receipts. And the speciality about the revenue head is it is associated with consumption. It is associated with consumption. Whereas the capital head is associated with capital, that is asset creation. So when you look at the revenue deficit, does it represent a dis-savings? That is more spending compared to your income under the revenue head? Yes. In India, neither the center nor any state has a revenue surplus. Right? Does center has a revenue surplus? No. Does any state have a revenue surplus? Yes. This is correct, by the way. This was in fact mentioned in economic survey as well. Back in the year 2018 and 19, there were around 18 states which had revenue surplus. 19 states. In fact, this particular number, the survey simply says, has actually come down now. It has come down to 11 states. So the statement, center doesn't have a revenue surplus? Yes. Any state doesn't have a revenue surplus? Incorrect. Second one is incorrect. Ceteris paribus, it's a Latin word which means all the things remaining same, unchanged. The higher surplus transfer by RBI will reduce revenue deficit. Yes, this statement is true. In fact, last year, the Reserve Bank of India transferred a record, the dividend transfer, record surplus transfer of almost 2.7 lakh crore rupees. When the government will receive this particular dividend, it will count it as a part of revenue account. It is an income, it is a receipt. Because the receipt increases, because the receipt collection increases, the deficit, that is the revenue deficit, will decrease. So third statement, ceteris paribus, higher surplus transfer by RBI will reduce the revenue deficit. Yes. 2 statements out of 3 are correct. Right option will be option B. Let's go forward now. Question number 3. How many of the pairs are correctly matched? Effective revenue deficit, Urjit Patel Committee. CPI as a nominal anchor, Rangarajan Committee. RBI surplus transfer to government, Bimal Jalan Committee. Now listen to me carefully. The CPI to be used as a nominal anchor for policy making. The recommendation of this was given by Urjit Patel Committee. Effective revenue deficit. What is the idea of effective revenue deficit? Within the revenue account, right? Within the revenue account, there is a component called as grants for creation of capital asset. The basic idea is, when you talk about the revenue account, there is no creation of asset. There is no change in the assets held by the government. Under GCCA, center transfers the grants to somebody else, states, they will create an asset. And because the center government's asset does not change, GCCA is kept under the revenue head. But there is a committee, or there was a committee, Rangarajan Committee. Rangarajan Committee recommended that this is not an accurate picture, because the GCCA in any case is going to create asset. Agreed, it is not under the central government balance sheet, but it is under, let's say the balance sheet of India. The assets in India will change. So it has to be removed, and that actually led to creation of effective revenue deficit. So the effective revenue deficit recommendation was given by Rangarajan committee. So first and second pairs are not correctly matched. RBI surplus transfer to the government. Just now I've discussed this. The RBI surplus transfer to the government, the latest committee which has recommended the formula is the Bimal Jalan committee. Third one is correct. Right option for the question will be option A. Question number 4 now. Consider the following statements. The interest payments done by the government on its debt is a type of a transfer payment. This is correct. What do you mean by transfer payment? Money is paid, in return no good or service is taken. That is transfer payment. Another example is remittances, welfare payments, right, given by the government. Why is the interest paid a transfer payment? Somebody will simply say, but sir, loan. My dear, the government will pay interest. Loan amount does not change. That is, a principal amount remains same. Government will simply pay interest. That's the reason it is considered as a transfer payment. A zero primary deficit indicates that the government is borrowing to finance its current year expenditures. If you know the concept behind primary deficit, you will be able to answer this statement. What is the basic idea? Primary deficit is equal to fiscal deficit minus interest payment. What does it actually mean? How much money you are borrowing this year, you are using it to finance current year expenditure. How much of it? For the past borrowing. Because the interest that you pay this year is on the loans that you have taken in the past. So out of the borrowing that you have done, how much is for past borrowing, interest payment, and whatever is left out is to finance current year expenditure. So when I say the primary deficit, when the primary deficit is equal to 0, what does it mean? Whatever borrowing you have done, it is essentially to pay for interest. Your borrowing is, let's say, 100 crore. Your interest payment is 100 crore. Does it not mean this borrowing that you have done this year, does it not mean you are not using any rupee out of it to finance current year expenditure? Every borrowing or every rupee that you have borrowed is for the interest payment. That is again associated with past activity, not current year activity. So second statement, zero primary deficit indicates that the government is borrowing to finance its current year expenditure is incorrect. Right option is option A. Question number 5 now. Consider the following statements regarding FRBM, Fiscal Responsibility and Budget Management Act. FRBM Act came into force or basically was introduced back in the year 2003. So the question is on that. It aims to eliminate fiscal deficit. FRBM simply states eliminate revenue deficit. What is the logic behind it? The target that was initially provided under FRBM is RD is equal to 0% revenue deficit, FD is equal to 3%. So now the question arises, how can we have 0% RD and 3% FD? Why not both of them 0%? It makes more sense. No. In market, there is a mantra. If you want to borrow, borrow for asset creation purposes, not for consumption. Revenue is for consumption. Capital is for asset creation. So the argument here is FD 3% means you're borrowing, but none of the borrowing you're using to satisfy the deficit in the revenue side. Hence, revenue deficit is equal to 0. So first statement, incorrect. The FRBM Act prohibits the Reserve Bank of India from subscribing to government securities in the primary market. Yes. Reason behind this is, if the government of India is selling bonds and RBI purchases them directly from the government, that means there is increased money supply. And this increased money supply will contribute to inflation. That's the reason this is not allowed. The third one, the government has decided to use the revenue deficit as the fiscal anchor. It is incorrect. Government very recently has decided it will use a debt to GDP. It will use a debt to GDP. And this is one of the recommendations of FRBM review committee, that is NK Singh committee. Third one, incorrect. So second statement is correct. Right option for the question is option A. So these are the questions I wanted to discuss with you people, which are conceptual questions based on the deficits that you must have studied by now. How many of you got all the 5 correct? And how many of you got the other numbers correct? That is 3, 2. Do let me know in the comment section. If you have liked the discussion, do not forget to hit the like button. If you are yet to join our YouTube channel, kindly do it right now. And before I close the discussion, again a reminder. Tomorrow the budget will be announced and we will have a detailed analysis of the announcements done in the budget at 6 p.m. live on this Unacademy IAS English YouTube channel. Till then, take care.